Today, we are digging into a classic Wall Street mystery. We're talking about Levi's latest earnings report. Now, this was a report that, by all accounts, should have sent the stock flying. Instead, it caused a massive sell-off that had pretty much everyone scratching their heads. So what exactly happened? Let's get into it.
All right, so let's get right into it. On the one hand, you've got the results. And I mean, what a quarter. Levi's didn't just beat expectations, they completely blew them out of the water. And they even raised their forecast for the rest of the year. That's what we call a classic beat and raise. But then you look at the market's reaction, a total bloodbath. The stock just got hammered, down over 12%. So what in the world is going on here? That's the paradox we're going to unpack.
So, to figure this all out, we're going to break it down into 4 parts. First, we'll look at those really strong numbers. Then we'll dive into what actually scared the market so badly. We'll also take a look at Levi's big picture strategy, and finally, we'll give you our take, the next call on what to expect, complete with our rating.
Okay, first up, the numbers. The stuff that, should have made everyone happy. On paper, things looked absolutely fantastic.
The company delivered a really solid beat on earnings. They posted adjusted earnings per share of 34 cents. The street was only looking for 31 cents, so that's a nice, clean win right there.
And it wasn't just earnings. Revenue looked great too. It jumped 7% compared to last year, hitting $1.54 billion. I mean, this wasn't just a small beat. This was a sign that the brand is still incredibly strong.
Now, this is where it gets really interesting. The real power behind this growth was their direct-to-consumer or DTC business. That's when they sell directly to you from their own stores and website. It's way more profitable. And get this, that part of the business was up 11%, with e-commerce alone just rocketing up 18%. Compare that to their wholesale business, which only grew by a pretty measly 3%.
So with a quarter like that, CEO Michelle Gass was, you can imagine, feeling pretty confident. She basically came out and said that their strategy is working so well that they were raising the financial forecast for the entire year.
So you've got a beat on earnings, a beat on revenue, amazing growth where it counts, and a confident outlook. You'd think the stock would be on a rocket ship, right? Well, it wasn't. It fell off a cliff. And this is where the story gets a little dark, and it's all about what's coming next.
Right? It makes no sense. All the pieces were there for a huge rally, but we got a complete rout instead. So what on earth did investors see that made them hit the sell button so aggressively? And here's the key thing to remember about Wall Street. It's a forward-looking machine. It's not about what you did last quarter. It's about what you're going to do next quarter. And the problem, well, it was buried in the fine print of the forecast.
And here it is, laid out plain as day. The company's forecast for the fourth quarter, it was a big letdown. They said to expect earnings of 36 to 38 cents, which is way below the 41 cents analysts were modeling. And the reason? That massive 100 basis point hit to their gross margins. 100 basis points? That's a full percentage point of profit just gone. That's a huge deal.
So yeah, this gross margin headwind was the smoking gun. Basically, the company was telling everyone that they were about to make less money on every single thing they sell. And the villain in this story? Import tariffs. Those rising costs were about to take a big bite out of their profits.
So this whole situation set up a classic Wall Street conflict. You've got the market totally fixated on the next 3 months of profit margins, and then you've got the management team trying to execute a huge long-term strategic shift for the company. And management's message on the earnings call was really clear. Hey, don't get lost in the short-term noise of these tariffs. We're playing the long game here. They're working on a multi-year plan to build a much stronger, more resilient business by becoming DTC first, expanding into a whole lifestyle brand, and growing all over the world.
And you can see that DTC first strategy is really working. Look at this. Almost half of all their sales now come directly from them. That's a huge deal. It gives them so much more control over their pricing, their brand, and just the whole experience you have when you buy a pair of Levi's. And they're proving they're not just about jeans anymore. Their tops business is growing like crazy, up 9%. The women's business is right there with it. They're becoming a brand you can wear from head to toe, which means you're going to spend more when you shop. And they're doing all this while actually getting leaner and more efficient.
So, where does that leave us? As analysts, how do we balance this very real short-term tariff problem against this really impressive long-term execution? Well, this is where we have to make a call and put a rating on the stock. It really comes down to this classic battle. The bull case is pretty simple. It's an iconic brand, they're executing their strategy perfectly, and that DTC momentum is for real.
The bear case is also simple. None of that matters right now because their profit margins are about to get crushed by tariffs.
So looking ahead to that Q4 report, here's what we expect. We think earnings will probably land right in the middle of their guidance, maybe around 37 cents. The tariff issue is out in the open now. Because of that, we see the stock pretty much stuck in a tug-of-war until we get some real clarity on that tariff situation.
So, with all that said, here's our official rating. We're initiating with market perform. Now, that is not a knock on the company itself. We think they're doing a fantastic job operationally, but these external tariff problems are just too big of a headwind to ignore in the short term. It's going to be tough for the stock to really break out.
Okay, but for those of you who are a bit more adventurous, there might be another way to play this. The real opportunity might be to bet on the uncertainty itself. An options trade, like a long straddle, could actually be a pretty interesting idea. The whole point is to profit from a really big stock move after the next earnings report, and it doesn't matter if it goes up or down.
So to wrap it all up, Levi's had a great quarter, but warned that trouble was ahead. The market panicked about the future, not the past. And this all leaves investors with one huge question. Can you handle the short-term pain for what could be a very nice, long-term gain?
And as always, please remember, this explainer is for informational purposes only. This is not financial advice.